Hello and welcome back to the Financial Streams podcast. I'm Patrea Brown and with me today I have
Michael Harvey.
And our hot topic for today, very topical, is the budget.
Big week for that one.
It has been a very big week and it has caused a lot of stress for some households and people going, well, how does this actually apply to me? So luckily for me today, I have Michael here with me, who is not just a financial advisor, he is also an accountant.
Yes, couple of hats, as they say.
Yeah, so very useful person to help me unpack what is happening with the budget. And at this point in time though, Michael, is it my understanding that none of this has been legislated? So this is the proposal?
Proposal, yeah, so the normal process. The government of the day provides a proposed changes to legislation, etc. Then it goes through a negotiation process through the House. My reading of the tea leaves and the commentary is that they have control with the power of the Greens, so it's not really expecting any material changes.
Yes.
There'll be a bit of argy-bargy around the fringes, but
this is probably what's going to go ahead,
yeah.
or what we should plan.
Start planning
that this is the changes that will come into place. Yep. Now, as I said, I was feeling a little bit stressed about this, but luckily for me, I am actually a client of MDH Accounting, and within 24 hours of the budget being announced, I had this very convenient newsletter handed out to me. Didn't you write this?
I did.
You and the team?
With some help from quite a few good friends. So.
Yes, so I found it really useful. So if you are an MDH client, I suggest you have a look in your inbox, and you probably have this in there too. And it's just a really useful breakdown of the changes, and we're going to go through that today, if that's okay with you, Michael.
That's great, Drew.
So I thought I would start with a very pertinent question. Are there any winners from this? Any small or big wins from this?
I suppose in macro terms, the superannuation sector as a whole is probably untouched, which is very rare in recent history.
It is, isn't it?
It normally gets tinkered with. So the last one, which is not this budget, was the Div 296, which applies to something of a percent of the whole Australian population, doesn't affect the majority. So really, in macro terms, the superannuation industry untouched. We'll take that as a win.
So at this point in time, if you have investments in superannuation, all of the language we throw around today, capital gains, all those things don't apply to you.
Yeah, that's correct.
Don't apply to super, I should say.
Correct.
Yes.
Yep.
Excellent.
And there's been no changes apart from CPI on things such as the maximum contribution caps you can put in, all that sort of stuff.
Yep.
So there's been nothing naughty slipped in through the cracks that I can gather at this stage.
It's always good.
Yep. So other winners, we'll take the 1%ers, so in small business land, the $20,000 instant asset write-off, which is a temporary measure that's come up and down over the journey. The $20,000 that's currently in place for FY26, the plan is to make that a permanent legislation of what small businesses. So just to remind, that's ABN holders classified as small businesses, so it's not someone who's buying something like a solar kit for a rental property if they're not in business. Yep. It's purely small business eligibility, and it's up to $20,000 instant asset write-off. So if you buy a car and it's $30,000, you don't get the first 20. So if something above 20, just normal depreciation applies. Okay. So you have to buy your car for
less than 20.
19,999.
And so can I just clarify with you, when you say small business, is that grouping together sole traders, partnerships, small business? That's
correct, yeah. So entity agnostic almost, so it doesn't really matter what entity structure you're in. So it's just a minimum turnover test, maximum turnover test criteria, and they've 20,000 turnover, I think up to 10 million, so it's a very broad range turnover test.
Excellent. And what about for the everyday Australian?
Everyday Australian, there is a little minuscule carrot in about, what are we now, 2 and a bit years' time.
Yes.
There will be a $250 tax rebate available for every paid employee, I think the wording was, basically salary and wage earner.
Yes.
So that'll come back as a credit in your tax return when you lodge your FY29, I reckon it would be, tax return.
Woo! $250.
So don't spend all that all at once, but yes, that's a small win there.
Something to look forward to in 2 years' time.
Another small win, which wasn't announced in the budget, had been announced previously, but does take effect from 1st July this year, is the the lower income tax bracket goes from 16% to 15%. So
Okay.
so there'll be a few dollars waiting for that.
Just to reset, if I 0 to 18,200 is tax free.
Correct.
And then from 18,200 to 45,000 is the bracket you're talking about. That will then be 15 cents per dollar.
Yep. That's right.
Okay. Any changes to other tax brackets, or that's
it?
That's just coming down.
Yeah. For everyday Australians, I mean, the rhetoric is about providing better opportunities for first-time buyers. That's the rhetoric. Whether you believe it or not, it's another thing, but that's the way.
But not with financial incentives, just with economising the housing market.
Well, they're trying to
free up housing.
Reduce the attractiveness for property investors.
Yes.
My take on it from a philosophical perspective, and then have a more moderate price increase on property prices, rather than having say an investor-fueled capital growth.
Yes.
That's what they're sort of arguing.
I think that's probably a really good interlude into our next topic, which would probably be the changes to property investors. So my understanding is they're twofold. There's one in terms of capital gains, which we can talk and unpack, and then there's one in terms of negative gearing. So I think if it's okay with you, we might start with the negative gearing, because the capital gains will apply to more than just housing.
Correct.
So what are the negative gearing changes?
To explain what negative gearing is, from my perspective, it's for a property investor to lose money from a taxable perspective. So how would you lose money, and why would you lose money is probably the two questions. So the how, typically it would mean a scenario where someone might have an existing property, maybe their home. They use the equity in their home and borrow 100% for an investment property. Therefore, they're maximising their loan and therefore maximising their interest component that's tax deductible against that investment income. That's one element.
Yes.
The other element tends to be where there's great depreciation benefits. What's depreciation? Depreciation might be you might buy a new unit with a new kitchen, new electrics, etc.
Yes.
Then there's greater depreciation on that type of investment compared to buying a house out of the 80s that had a second-hand kitchen.
Yes.
So you get some of the depreciation benefits.
And my understanding is that you can't there's not necessarily a fixed percentage or things, often a depreciation schedule or other things are quite...
Typically people get the depreciation report out of someone like a quantity surveyor type of organisation, and that gives you a schedule what you can claim. So by putting that in there, then you end up with a tax loss.
Yes.
And then you can offset that tax loss against your other taxable income. So typically you see it as high income earners might be the top tax bracket of 47%, and therefore any $1,000 loss, then you get a $470 tax saving at the 47%. That's how the negative gearing setup works. So what they've announced is that from budget night, that you won't be able to do that for any new properties going forward.
And that's from the date it was announced, not
Correct.
from the new financial year.
That's
They're
right.
saying don't rush out and buy a property, it's too late. We are just putting a stake in the ground now and saying any property purchases from tomorrow onwards will come into effect.
With the exception of new builds. They have done a carve out from that day forward that if you're investing in a new build, either apartment or house, then you'd still be able to access that. Otherwise, my understanding would be that you just can't offset that loss, and I don't think you can offset that loss against other gains, but I'm not 100% sure. I'm just waiting for some of that detail to settle. In the scheme of things, it's a percentage. I mean, the government have the stats. From my perspective, I don't see a lot of that activity. And a client asked me yesterday, I said, should I go into that negative gearing scenario? I said, just crunch your numbers. Don't just do it because you want to make a loss and get a tax deduction. It goes back to the basic principle of tax deduction. You still got to incur a loss to get a tax deduction. Yes. Then you can get an offset or a contribution effected by lower taxable income, but you still got to come up with a loss.
You've still got to have a loss. Yeah. So whether or not that loss works in your favour or not, and how you're doing it, yes, I can see. So I've got it really clear in my mind. So anyone that owned a property before that date,
Yep.
and though nothing changes for them. In terms of
That's
negative
my
gearing,
Yeah.
they can still continue on as they are.
Yep.
Going forward from the announcement, new builds can still have negative gearing under exactly the same
My
rules.
understanding. Yep.
But existing dwellings, if you purchased it after that announcement,
Yep.
you cannot negatively gear it.
Yep.
Is that correct?
Correct.
Now, you might not know this. This might not have been announced yet. I guess one of the questions that comes to my mind around this is with the existing dwellings, have they announced any caveats around it had to have already been a rental? Like, do you know what I mean? If you already own, let's say you bought a house, you're intending it to turn it into a rental, it was just kind of an in-between dwelling until you purchased your forever home. You had a really good accountant who recommended you get an offset account.
Yes.
So that you did purchase it, 100%.
Yeah.
What in that scenario, has
It's a
there
good
been
scenario.
any caveats around if you then go to rent that out? I have had a few people ask me this.
Yeah, I don't
and
know
I went,
the answer. Only that my reading of the announcement was that it had to be owned.
Just had to be owned.
That's my reading of it. Some of this stuff will come out when they actually draft the legislation. If there's any caveats, but as far as I'm aware, it was
it's more about the ownership
test, not a use.
That's what I thought. Yeah. Excellent. Yeah, and I'm sure there'll be more detail to come. This
Yeah.
is, as we said, none of this is legislated. This is a general discussion, just unpacking
hit
what we've
notes.
heard so far.
Yeah.
And things may change.
Yep.
So don't take this as gospel. So was there anything else you think negative gearing related or?
No, I think that sort of summarises negative gearing.
Yeah.
And so that's purely a property related activity or change. So,
Yes.
Yeah.
And so then the other half of that was the capital gains implications, because there was fairly major announcements about that. And my understanding of that is that super excluded, so we're not talking about anything in the superannuation environment, but that outside of super, that the new CGT rules apply to all asset classes.
Correct.
So it's not just property, it's shares, it's everything. Is that correct?
A lot of the commentary has been around property and what that looks like. But yeah, there was pretty much my understanding there's all asset classes, as in like property, shares, crypto and all that sort of stuff. So that'll be interesting to see how that works, things like that.
And so just to revisit my understanding of the current capital gains rules before the announcements, my understanding was that if you had purchased an asset and held it for more than 12 months, that you're entitled to a CGT discount, which would be effectively 50% of whatever profit you've made since the purchase date.
Yep, and that's called the general discount. So just to sort of get down a little bit of tin tax, so that excludes all the other small business capital gains concessions and exemptions. So we're just talking about the general discount, which most people would have seen their property, investment
so an
property
investment property, or if I've held some
share
shares
portfolio,
for 12 months,
that's
and so just in layman's terms, so if I had made $100 gain on my shares, and then I got a 50% discount to that, so it's $50. And then so that means that only $50 would be added to my income and taxed at my marginal tax rate. Is that correct?
And that last comment, marginal tax rate, because that's a common question to get. What's the capital gains tax rate on that? And there's actually no specific capital gains tax rate. It's a calculation that gets bundled into your tax return, added to all your other taxable income, and exactly what you said, it's your marginal tax rate. So you do see some people go from the 30% bracket up a couple of brackets because they might have a large capital gain in that financial year. So it gets taxed effectively at your whatever the rate, the bracket you fall into. That's just a side point. So.
Yeah, and so that was the existing rules prior to the budget. Moving forward, what are the new rules?
New rules effectively that'll go to a CPI linked model, but unlike negatively gearing, we are allowed a period of time to work through that, which is till 1st July 2027. when the new capital gains rules will take place.
So that means that if I'm holding an asset and it's still appreciating in value, that any of the, and I've held it over 12 months already, any of the gains that I get up until the 1st of July 2027 is still subject to that 50% general rule. And after that, a new change will kick in. So is that going to be stake in the ground, kind of have a valuation done then, or how are they going to work it out?
That's seems to be the announcement, that it's a valuation based. And we were debating the other day, weren't we, that whether it was going to be a pro rata based on the number of days of pre and post the two different methods, but it seems to be that stake in the ground 1st July 2027. So if you value,
sounds like they don't want everyone to sell everything.
If you're valuing,
no great capital gains reset. Yes.
And there is some nebulous wording which I don't fully comprehend about. You could apply some average indexing rules to come up with your valuation.
Yes.
My reading of that is that I'd rather just get a proper valuation if I was a property owner.
Yeah, get a valuation, know what it is, lock in those unrealised gains so that you have the discount applicable on them.
Yeah.
And then if you're going to retain that asset, the new rules will apply moving forward.
Correct, that's it.
Yeah. Which for me, that sounds pretty messy from like a taxation point of view. You're going to have to keep you're going to have to get good at Excel.
Yeah. So the capital gains assessable income calculation is just going to get a whole lot messier.
Yes.
Because effectively if you sell a property post 1st July 2027, then you're going to have two calculations on two different methods.
Yes.
Based on two different
the pre and
valuations.
post valuation components. Yes.
So
fun for your team.
Yeah.
I don't work in that space.
So that'll keep us on our toes.
Yes.
And I suppose the underlying message is that there's no need to make any knee-jerk reactions. We do know what the rules are likely to be, bearing in mind our caveat of wait for the detail in the legislation. But we sort of know what the game is. I suppose I was not looking forward if had made it retrospective, as in like gone back in time.
Yes.
So we do have it, and we've also got a bit of planning time to say between
2027. So July 2027.
14, 15 months.
Yes.
To basically think through, and it'll be, just talking to a few different clients. Some people go, "Oh, this is all getting too hard and complicated," or "No, let's just plan this properly," and it might still be the right investment choice still to hold that property and
I guess from my perspective, there's a lot of considerations that come into whether or not it's the right time to buy and sell an asset, depending on what your tax bracket is at the time of the sale, depending on what your gain has been up to that date. And I guess it depends on what type of asset too. Like, something like a share portfolio might be, a simple thing with minimal costs, sell costs, depending on the value of it, to liquidate and reset and then have a more simplified tax system. Whereas, when you get down into property and you start to deal with stamp duty and other, the overheads for it, it's an expensive change. And you've got to weigh that up. What's the stamp duty on a $600,000 house this day? You're looking, depending on
20 odd grand. So.
Yeah, it's anywhere 20 to 30 is what we've been seeing come through. And so you go, well, and then you're going to pay that again if you're going to buy a different property to reset. So you start to go, well, maybe take your time to consider these things.
Crunch your numbers through.
Yeah. So just in my head, retrospectively, the only thing that has changed now going forward with the rules is that for the negative gearing, no one going forward can do it, new people and new purchases, except on new properties. That's already in effect. But for the capital gains changes, that's not coming into effect the 1st of July 2027. Is that correct?
Correct. And just to sort of pick up another little point just come to me while you're chatting about that was pre-1985 assets have always been...
Yes, the exempt ones, the golden exempt, fully exempt, will never touch grandfathered assets.
So that will change, which is a little bit of a surprise.
So what is the change for that? Previously, they were not subject to capital gains at all. Is that correct? They were like exempt assets. You could make as much money on them as you wanted. And when you sold them, you kept all the money. Is that right?
That's total exemption.
A total exemption, and that is going to cease as of the 1st of July 27. Any gains made past that date will be subject to CGT rules.
Correct. So
Yes.
It's a big change.
That is a big change for
someone
that.
had asked me yesterday,
I'd
do I have
forgotten
any
about
assets
that.
in that space?
Yeah.
And I said,
I saw that and went, oh, I can't believe they've touched that. But anyway.
That was a surprise. So once again, not the end of the world, but basically it's not going to be totally exempt. So from 1st July 27, get a valuation done. Up until that valuation is going to be exempt gain, and then any gains you have post the 1 July 27 valuation would be taxed under the new CPI based capital gains tax calcs.
Which was 30% plus CPI, is that right?
No, so so your capital gains calculation will be based on anything above the CPI.
Okay.
And then the minimum rate, which is another little sleeper, that you'll pay. So my original comment, there's no separate capital gains tax rate, will change a bit.
Yeah.
Because we're going to have a minimum amount of 30% tax payable on capital gains.
That's what that 30% was. Gotcha.
Whereas at the moment, you know, a bit of tax planning, you might say, oh, I'm going to retire next year, therefore I might sell my asset, have no other taxable income, and have the capital gain in the year that I retire. Now that's going to change a bit. You're going to pay a minimum 30% on that capital gain, no matter what your other taxable income is. So there's a bit of an adjustment to your planning on capital gains.
Right. So you're saying to me that even if I structured it, if let's say theoretically I was self-employed and structured in such a way that my income that year was under the tax-free threshold and I wasn't paying tax, and I was going to use that as my income, you're saying I'd still pay 30%?
That's my reading of it,
Yeah, okay.
So it's a little bit of a change.
It is a bit of a change, isn't it? But I'm sure there'll be more detail that comes out around that, about the logistics of how they're actually going to put that into effect.
That was the announcement though, so one to watch.
One to watch for that. So I think, does that summarise pretty much the capital gains changes? So I think the last thing to unpack today is probably what's happening with discretionary trusts.
Well, yes, that's a significant change.
That's
predominantly from a small business perspective. So, so just to sort of summarise what the announcement was. So we're purely looking at discretionary or family trusts is the same type of entity. People call them slightly different things.
And what do people normally use those for? Just as a general overview.
So I see them either as a trading entity, so you might have a business that trades through a family trust structure, or it might hold property in a family trust structure, or it might hold other forms of investment. So sometimes you might have a business owner who holds the shares in their business company in a family trust. Why is that done? Historically, that's been for asset protection and then flexibility for income flows.
So you'll still have the asset protection, but the flexibility with the income flow is about to tighten.
That's right, yeah. So what the announcement is anything in that discretionary trust ownership and income flows, the trustee of the trust, which is the boss, so to speak, will pay the 30% tax on the earnings of the trust. So at the moment, the way our trust works, so if it makes $100, you and I are the beneficiaries of the trust, we get $50 each, we'll pay tax at our marginal tax rate. So that's the current way of setting it. What going forward will be is that the trustee will make $100, pay $30 to the taxman, and then give us the credit. So
will the beneficiaries still pay tax on that? Or will the tax be paid already?
You still pay tax on it, but you have tax paid at the 30%. But it's not refundable. So if you're on a low income bracket, so go back to your other example, I'm a low income, that's just money lost because you've paid a minimum of 30% on that. So
and that's not refundable. So I can't get it back? No.
But if you're at a higher tax bracket, then it's not the end of the world because you pay the difference. Yeah, you just pay the difference between 30%.
So you would get that tax credit if you're in a higher bracket and then pay the difference. Yeah. Okay.
So that's not the end of the world for some people that are beneficiaries.
I guess I think, you know, probably the main people I see that affecting are anyone that has, you know, maybe circumstantial changes where they've gone from being in that kind of 30% marginal tax rate where they're between that 45,000 to 135,000 bracket. Yep. If suddenly, you know, they're unemployed for whatever reason, might be on maternity leave, or might, you know, maybe someone's just newly retired, but they've, you know, been doing a business together and they're still having income, you know, distributed to them. Suddenly, we've just said that anyone earning from kind of that tax-free threshold up to 45,000 is only paying 15 cents per dollar now. If suddenly 30 cents
That's
to
right.
the dollar applies, it's
Yep.
no longer worth distributing that income to them.
That's right.
They're actually going to pocket a tax loss.
Yep, that's right.
Yeah.
So anyone in that below 45k taxable income, that becomes problematic or not non-beneficial to be a beneficiary of the trust. But that scenario, in I suppose business world, there's been like what they call bucket or beneficiary companies, which has been a way of say if a construction company had a really big year, they might put some of those funds aside into a bucket company, say for a future.
Yes.
So
But the trustee is going to pay 30% on
30%,
that.
and the shocker in this one is that the company who receives that doesn't get the $30 credit.
They don't get the credit.
So they'll pay tax at their rate, so another 30%. So effectively it's 60% tax rate on any money that goes to the company.
So really, depending on, obviously we've said that the trusts still apply for asset protection, and you got to think about your structuring around that. But realistically, probably companies have a more flexible distribution structure now versus the discretionary trust. Would that be a fair statement?
Right. Yep, it's a fair statement. And even in the announcement, they've allowed, I think, a 2 or 3 year restructuring period for business owners to restructure out of trusts into company structures, or I think they're allowed other structures, but it's going to be a trust to a company without any unforeseen consequences of paying capital gains tax, whatever. So that's where they want people to move to a company structure, basically.
Yes, and so my question is, when does that come into effect? Is that like
I think
also the 1st of July 2027? I'll just see, my accountant who sent this through had this in here. 1st of July 2028.
For the relief?
30% minimum
28,
tax.
yeah, so we've got, what have we got, 2 years?
Yes, and then you've said the temporary rollover relief is from the 1st of July 2027 through to 2030.
Yep, so
a
1 year beforehand and a couple after as well. So it's at least a silver lining that we've got some time.
Got time to think about what structure might suit you best. Depending on, it's not just as simple as tax relief.
The more problematic ones will be where people own properties in trusts.
Yes.
Because of that stamp duty issue and capital gains tax issues. If you were to say, going forward, I'm better to hold my assets in a company structure because, the trust tax rate has changed. Therefore, and then what I want to do going forward has changed. Therefore, people say, okay, I might buy new assets.
Yes.
Because historically people might have held it in a trust rather than a company because you get access to 50% discount.
Yes.
Come July 27, that's gone. So you go, okay, my whole world's changed. So I was watching one of those shows the other night and they had this young dude owns 20 properties. He said, all for him is going to restructure. He said, I was buying companies going forward. And that was his simplistic response. But for those sophisticated, active property investors, they're going to move to that type of structure.
Of course.
It's probably the mum and dad, the 1 or 2 investment properties who might have held that in a trust for various reasons, and some are quite legitimate because you want to, you look at trust laws that come out of England, which was a way of passing assets from one generation to another.
Yeah.
So the actual concept is still really sound. Obviously, it's been used for different purposes over the last few decades, but sometimes you want an intergenerational property. And so they are held in property trusts.
Yes.
So, but I suppose these are another level of complexity that's come in that you really need to sit down with your advisor or really have some thinking time to plan these things out properly for yourself.
Yeah. So for, I guess moving forward, what role do you see discretionary trusts having in this new climate? Still asset protection, obviously, or intergenerational passing down of property might still apply. Can you see any other uses of them?
I can't think of a strong argument for them sitting here today. I think, like everything, you have pendulum swings, so all of a sudden it's going, trusts, why would we use a trust? I was having a chat to another accountant earlier today, and he's talking about testamentary trusts and how that's going to work. And that's a whole another range of conversations. So a lot of this stuff will just filter out, settle through, and then there might be some schools of thought that come out and say, discretionary trust will work through in this type of scenario. So I'm not saying dead in the water. But
Yeah.
I can't think of a strong argument sitting here today where a discretionary trust may be better than other structures.
Yeah.
So the world's changed.
The world has changed. The world
Our
has
tax
changed.
world and business world.
Very
and
much so,
structural world.
but there's time, as you
Yeah,
said,
that's right.
there's
Work's plenty of
time
time.
allowances to sit down and talk to your accountant, talk to your financial advisor,
Yep.
explore your personal circumstances, see how much your world has changed. Like we said, for depending on what you're holding in your trust, your family
Yeah.
trust, if you have one, if it's not property, if it's other things, and you're not low income earners and the marginal tax rate stayed the same, then
Yeah.
your world might stay the same
Yeah.
for a while or an element of time, depending on what you're using and how you're using it for. So it's not a sell or rush into
No,
anything,
and
but
even-
it's just things to consider.
And even the majority of financial streams clients in that superannuation environment, there's really no changes in that space. It's probably only those clients who might have outside super
Yeah.
investments where the changes of the capital gains tax will apply to, say, if they've got a managed fund arrangement, whatever the type of investment,
Yeah.
then that will change their potential tax position
On
out of
those
that-
assets
of those
after
investments.
the 1st of July,
After 1st July
2027.
27. Yep.
Yeah, so you got time. You
Yep.
got time to book your meeting,
That's right.
book your review,
Start.
and line up your ducks.
Start thinking about that.
Do you think there was anything else that I've missed?
No, I think
No,
it's
it was
pretty
a very very good newsletter. So I have to say, if your accountant's not all over this, sending out updates, then yes, mine is better. So I think that's all we have time for today.
Right.
Then yes.
Yes.
Yeah.
Thank
Thanks,
you,
Michael.
Patrea. Thank you.